Okay, so I've been getting a couple of questions from my other videos saying basically, what are you talking about? I don't understand this term. What does this mean? What does that mean? Etc. So in this video, I'm going to be making a bit of a guide to the stock market, how to traverse the stock market with all these different terms. And it's not going to go in depth into any of them, but it's just going to kind of cover broadly some terms that you kind of need to understand to get a better idea of what is going on. So if that sounds like a good idea, if you could take a second to drop a like on this video, that'd be very much appreciated. Okay, let's start off with an easy one, a stock versus a share. So we can think of a stock like a company. So for example, Apple. And then we can think of a share as having a stake in that company. So for example, I could have 10 shares, but only one stock. So then 10 shares would be of an Apple stock. I could have 2 shares and 2 stocks. So I could have an ownership of 2 different companies and have 1 share of each company. So essentially we think of it as a stock is a company and a share is how much you own of that company. Now, what's a fractional share? Now, I actually covered this in my previous video where I talked about finding the best brokerage. If that sounds interesting to you, definitely go ahead and check that out on my channel. But anyway, a fractional share is, as the name suggests, where you don't actually have to buy a full share, you can buy a fraction of one. So if a share is currently priced at $100 and you buy half a share, that will cost you $50 and you'll own 0.5 of a share. So that's essentially how that one works. It's pretty easy. Now, when I covered in my last video, some stockbrokers don't actually offer fractional shares, but you are starting to see more people offer it, and that's how people can get into investing and invest into their favorite companies from just a small amount of money. Next up, we have market cap. Now, this signifies how much the company is worth on that day. As I said on that day because these things change quite a bit. The higher the stock price goes, the higher the market cap goes. But that being said, you need to keep in mind that if, for example, Apple stock is $130, their market cap is much bigger than Tesla, for example, who have a stock price of $800. So while there is a correlation there between how high the stock price goes and how high the market cap goes, there's no direct correlation, for example, between a $100 stock means it has a market cap of 1 billion. That's not how that one works. Next up, we have the PE ratio, which stands for price to earnings ratio. Now, I'll have the formula on screen here to make things a little bit easier for you guys, but essentially it's a metric to show you how overvalued or undervalued a company is in relation to its earnings and share price. Okay, so next up we have profit or income. So there's 2 different types of this. You can get profit from the sale of shares, and you can also get income in the form of dividend income. Let's look at profit in the sale of shares first. So in this instance, we have unrealized profit and realized profit. Unrealized profit is where you haven't sold the share yet, so you haven't actually realized them gains or them losses. And realized profit is where you've actually sold it and you actually have a tax liability now on that profit. But taxes are a whole different thing, so I'm going to have a separate video on that covering specific taxes for Ireland. Let me give a little bit of a further example on that one, which I've actually used before. So let's say, for example, a stock is trading at $100 and you buy 1 share of that stock. In a couple of months' time, the stock price goes to $120. You now have an unrealized profit of $20. If you decide to sell that, you now have a realized profit of $20, and that is what will need to be taxed. In the context of Ireland, this is taxed under capital gains tax, and again, I'll have a full video covering this because it's quite an in-depth topic. But if you're not from Ireland and you're watching this video, make sure you familiarize yourself with the tax laws in your area. Next up, we have dividend income. Now, a dividend is where companies pay a share of their profits to the shareholders. Not all companies do this. Generally, kind of growth stocks like to reinvest their profits into more research and development and growing the business. But for example, Apple and Microsoft, who just have loads and loads of cash, more than they know what to do with, they pay out some of their profits in the form of dividends. Dividends can be paid monthly or quarterly, depending on the company. In the case of Ireland, dividend income is taxed at your marginal rate of tax, so it is not capital gains tax. It's just whatever your income tax is. Now, 2 terms you may hear are bullish and bearish, or you're for a bull or you're a bear. So let's explain them too. So essentially, if someone is bullish about a certain stock, that means they think the stock is going to go up in the future. It means they're optimistic about the company. If you hear the term bull market, it means the whole market in general is on a bull run, which means it keeps rising. Now, opposite to that, if somebody is a bear about a specific stock, for example, they think that company is basically overvalued. They think it's going to go down in the future. They think the stock price will go down, the performance will go down. Generally, they're pessimistic about the company. And if you hear about a bear market, that generally means that the stock prices are plunging and things are just generally on a downward trend. 2 other terms you may come across are aftermarket and pre-market. So when the market closes, there's a couple of hours there where it gives a stock price, a stock quote called aftermarket. Now, some people can actually trade within these market hours. That depends on your broker. Sometimes you can pay extra to have the ability to trade at these aftermarket prices, but generally they're more volatile because there's a smaller amount of people buying the stocks. Similar to that, you also have pre-market, where a couple of hours before the market opens, you can see some stock prices quoted. I'll have an example on screen here, and generally some people can trade in pre-market hours as well, depending on your brokerage. Another term you may hear is stock split. This is generally done to bring stocks down. So for example, if we're looking at Amazon, which is about $3,000, they could do a stock split, for example, a 3-for-1 stock split, which would make their share prices $1,000 opposed to $3,000. So in that example that I gave of Amazon, if you have one share at $3,000 and there's a 3-for-1 stock split, you'll now have 3 shares, but they'll still be of the same value of 3,000. So essentially nothing really happens for the shareholder. It's just that the company brings down their share price and allows people to be able to buy in at a lower price. Now you may have heard of lots of different kind of funds like index funds, ETFs, mutual funds, lots of different things like that. Essentially they're a basket of stocks often managed by different companies. Let's take for example Vanguard S&P 500. This is by Vanguard and it's their version of tracking the S&P 500. So if you invest into this, you're essentially investing into Vanguard managing the tracking of the S&P 500. And the S&P 500 is a list of the top 500 companies in the US. You may also have heard of an ARK ETF as well, and that's managed by Cathie Wood. That's another example of it, except that doesn't invest in the S&P 500. They go for a different kind of route and they're picking more disruptive stocks and they're changing that throughout the day. And essentially it's managed by them. So you just put your money into the fund and then they manage the money for you. Now I did oversimplify that quite a bit, but I don't have enough time in this video to go through the in-depths of all of these kind of things. But if there's anything that I mentioned in this video so far that you want to see more on, let me know in the comments below. Next up, we have diversification. I'm sure you've heard people say stay diversified. It's important to be diversified. So what does that mean? So in the terms of stock market investing, diversification means owning a lot of stocks. It means spreading out your risk. So the more stocks you own, generally the more diversified you are. Diversification can mean owning stocks from different sectors such as the tech sector, the healthcare sector, the general consumer sector, all different kinds of sectors. So if you can spread your money across these, you can generally say well diversified and spread your risk. There's pros and cons to diversification. The more stocks you own, the more stocks you have to keep an eye on, and generally the less your gains will be. If you have a load of stocks, one of them shoots up 100%, but it's only at a 2% weighting in your portfolio, you're not going to see massive gains. Obviously, all gains are good, but if you just had that stock, for example, you would see 100% gain. So essentially, the more stocks you own, the more you kind of reduce your risk, and the less stocks you own, the more you kind of increase your risk. But as I said, there are pros and cons to both, so it's up to each individual to decide what strategy is best for them. Another term you may come across is shorting. So I'm sure a lot of you have seen the movie The Big Short. Essentially, shorting means betting against the market. So for example, if we are in a bull run, to use a term I've used before, if we have a bullish market, somebody may think this is too high, this is going to fall, and they may short the market. So essentially, they're betting on the market falling, and as it falls, they will make money from that. Now again, shorting is a complicated topic and I won't get into it fully in this video. You may have heard some other terms like options, futures, and CFDs as well. Essentially, this allows you to bet on the future of a stock. Again, these are very complicated things and something I need to learn more about myself, so I won't cover them in this video. But that's going to wrap up today's video, guys. I just wanted to give a brief kind of overview of some of the terms you may hear when it comes to stock market investing. As I said, if there's anything in this video that you want to hear more about, let me know in the comment section below and I may do a more in-depth video on that one. Or if you enjoyed this kind of quick fire style where we covered a lot of topics, let me know in the comment section below if there's any other terms you want me to explain or things like that, and I may do an episode 2. If you could take a second to like this video, it would be very much appreciated. Subscribe if you like the content, and I'll catch you in the next one.